So today, let's talk about a really powerful mental model for investing. It's one that's, often overlooked. It's a way of thinking that actually governs a market that's twice the size of the global stock market, but it's a perspective most of us are just never taught. We're going to dive into what's called the creditor mindset.
Okay, picture this. You're at a dinner party, right? And the conversation, as it always does, eventually turns to money. And someone looks over at you and asks that classic question. So, what do you invest in? Now, how you answer that question, well, it reveals pretty much everything about your entire financial philosophy.
Most people, they answer with ticker symbols. Oh, I'm an Apple, a little bit of Tesla, but mostly just the S&P 500. That's the standard playbook. But there's another answer, one that almost always just stops the conversation cold. And that answer is, I'm a lender. An answer like that, it suggests a completely different way of seeing the entire world of finance.
And here's why that's so interesting. The global credit market, that's the world of lending, it's valued at around $250 trillion. Now, the equity market, the world of stocks, is less than half that, sitting at about $110 trillion. So the big question is, why do we spend all our time talking about the smaller market and almost no time at all on the one that's twice as big?
Well, it really all comes down to the lens you use to look at a balance sheet. You can either be the one who owes the money, or you can be the one who is owed. And that is the fundamental shift we're going to explore.
So the debtor, that's the person taking on a loan, they're always asking, how much can I afford? It's purely a question about capacity. But the creditor, the lender, asks a totally different question. They ask, what is my probability of being repaid, and am I being paid enough for the risk I'm taking on? You see how that one little shift from hoping for upside to analyzing the downside, it just changes everything.
So, why isn't this mindset more common? Well, it's not by accident. The financial system has these built-in incentives that are designed to point you towards equities. Advisor fees, for instance, they're typically higher on stocks. And let's be honest, equity funds are so much easier to market with these exciting stories of, 10x your money. Meanwhile, a bond fund promising a steady 6 to 8% a year sounds, well, kind of boring. The entire machine is basically designed to point your attention to the smaller, more volatile side of the market.
And this really gets to the core value of the creditor mindset. It's not about chasing the highest possible return you can find, it's about preserving your capital, because that, and only that, is the absolute foundation for long-term wealth compounding.
The great investor Howard Marks put it perfectly. The real risk isn't that your portfolio goes down for a few months. That's just volatility. The risk that truly matters is the permanent destruction of your capital, a loss that you can't come back from.
Let's make this real. Think about 2008. An investor with a pretty standard 60-40 stock and bond portfolio watched their assets get cut by more than half. It took them five full years just to get back to where they started. That's 5 years of zero return. At the same time, an investor with a creditor mindset saw all that panic as an incredible opportunity. They went in and bought distressed corporate debt, basically loans to solid companies that the market was terrified were about to go bankrupt. They bought it at huge discounts, locking in yields of 15 to 20%. By 2010, they had doubled their money. Same crisis, two completely different outcomes, all based on mindset.
So, how is that even possible? It's because creditors understand the rules of the game. They understand their position in what's called the capital structure, which is the legal framework that dictates exactly who gets paid first when a business gets into trouble. And this waterfall just illustrates the hierarchy perfectly. When a company is facing financial distress, there is a very strict legal order of payments. At the very top, first in line to get their money back are the senior secured creditors, the lenders. And then all the way down at the bottom, last in line to get whatever scraps might be left over, are the common equity holders, the stockholders. As a lender, you are contractually, legally positioned to be paid before the owners. And let me be really clear about this. This isn't a guideline. It's not a friendly suggestion. This is a legally binding hierarchy. It's law. When Lehman Brothers collapsed, the stockholders got wiped out completely. But the senior creditors, they actually got a substantial recovery because their claim had legal priority. This legal standing, it allows creditors to look at market cycles in a completely different way. For a stockholder, a market crash is just a source of fear. But for a creditor sitting on cash, a market crash is a source of incredible opportunity.
And if you look back, history shows this really clear repeating pattern. I mean, whether it was the LTCM collapse back in '98, the dot-com bust, the 2008 financial crisis, or that COVID shock in 2020, every single one of these periods of panic created a massive dislocation in the credit markets. And that presented a generational opportunity for lenders.
To make this even more concrete, let's just stick with 2008. Before the crisis hit, the extra yield or the spread for lending to a high-yield company was about 2.5 percentage points. That's 250 basis points over a risk-free government bond. That was the going rate for taking on normal risk.
Okay, now fast forward to the peak of the panic. That exact same spread, it exploded to 20 percentage points. 2,000 basis points. That is an 8-fold increase. You were being paid 8 times more to take on risk at the exact moment when everyone else was absolutely terrified of it. The lenders who stepped in at that moment were locking in returns that could double their money in less than 4 years.
And this is really the essence of what Benjamin Graham, the father of value investing, was always teaching. The intelligent investor doesn't follow the herd. They are the ones who provide the cash to the market when it's pessimistic and fearful, and they're the ones who are cautious when the market is optimistic and greedy.
But we have to be intellectually honest here. This mindset is not some kind of magic bullet. It is definitely not without risk, and understanding the limits of the creditor advantage is just as important as understanding its strengths.
So let's look at a pretty sobering real-world case. Back in 2009, lenders to Chrysler held what's called first lien senior secured debt. Now, what that means is they were at the absolute top of the capital structure. Their loan was backed by specific collateral, and by all legal accounts, their position was supposed to be the safest place you could be in the entire company, other than, a government bond.
And what was their recovery in the bankruptcy? Just 29 cents on the dollar. A permanent loss of 71% of their capital. So, what happened? Well, in a moment of national crisis, the court, under immense political pressure to save jobs, prioritized those goals over the strict letter of bankruptcy law. They allowed more junior stakeholders to jump ahead in the line. It's a really crucial lesson. Your legal standing is only as strong as the system that's enforcing it. And when a company's entire value collapses, even being first in line for what's left can be devastating.
So this brings the focus right back to you and your own goals. The first question you should ask yourself isn't, what stock should I buy? It's, what am I actually trying to achieve? Are you trying to build a source of steady, predictable cash flow to live on? Or are you chasing long-term price appreciation? Neither one is wrong, but they require very different approaches. And the next question really gets to the heart of what we've been talking about. Look at your own portfolio. Are you primarily positioned as an owner, the person who gets paid last in a crisis? Or have you allocated some of your capital to the position of a lender, the person who has a contractual right to be paid first?
And that leads to this final logical challenge. We have established that the credit market is double the size of the equity market. So why do the portfolios of most individual investors reflect the exact opposite? Why are we all allocated almost exclusively to the smaller, more junior part of the capital structure? Is that something we've chosen by design, or is it just by default?
Look, this isn't about abandoning stocks or becoming some full-time bond trader. It's about transforming your perspective. It means asking if your portfolio is balanced not just between asset classes, but between the mindsets of an owner and a lender. So the next time you're looking at an investment, just ask yourself this one question. Am I thinking like a creditor, focused on risk and my probability of being repaid, or am I just thinking like everyone else? That single shift in your mindset could change more about your financial future than any single investment ever will.